Okay, imagine trying to explain exactly how well a company is doing to someone. You'd probably start with sales, right?
Yeah, absolutely. That big number at the top.
That big number at the top of the profit and loss statement. But figuring out when a company has actually earned that sale, that can feel like, well, trying to catch smoke sometimes.
It really can.
Okay.
It's fundamental to financial reporting, and honestly, one of the areas accountants grapple with most.
Definitely.
Because, revenue is the lifeblood of a business, but recognizing it correctly isn't just about when the cash comes in. It's really about when the company has fulfilled its promise to the customer.
Hmm.
Get that wrong, and your financial statements, well, they just don't show a true picture at all.
Absolutely. And that's why this topic is just so critical, especially if you're preparing for the ACCA financial reporting exam.
Uh-huh.
So for this deep dive, we're doing a targeted revision session just for you, the student, focusing on a major player in the syllabus. Chapter 5, Revenue Recognition.
Right, and our mission here is basically to cut through the noise, unpack the core principles of revenue recognition. We're using your sources specifically, the official ACCA FR syllabus and study guide for 25 to June 26.
Yeah.
And that helpful visual overview of Chapter 5 you mentioned. Think of these documents as our kind of guide map for this revision journey.
Okay, let's unpack this then. When you look at the FR syllabus, it's structured around these key capabilities you need to master. And our topic, revenue recognition, sits firmly within Area B.
Area B, accounting for transactions and financial statements.
Exactly.
And that positioning is really important, isn't it? Because before you can prepare a full set of financial statements, which is Area D,
Right.
or analyze them effectively, Area C, you first need to know how to account for the underlying transaction.
Makes sense.
And revenue is, well, it's one of the most significant transactions a business undertakes, so understanding it is definitely a foundational skill.
And the single standard that governs all this is IFRS 15, revenue from contracts with customers.
That's the one.
The visual overview for Chapter 5 puts the objective front and center. You need to understand the principles of revenue recognition and how it should be measured.
Precisely. And IFRS 15 gives us a really clear framework for this. It's a 5-step model.
Ah, the famous 5 steps.
The 5-step model, yeah, that you apply to contracts with customers. This model is really the backbone of Chapter 5, highlighted in both the visual overview and the study guide.
Okay, the 5 steps. Let's walk through them. Step 1, identify the contract with a customer. What does IFRS 15 actually consider a valid contract that falls under its scope?
Well, the study guide under B10A talks about explaining and applying these principles, and the very first step is identifying that contract. And it's more than just, a handshake.
Right.
For a contract to be within IFRS 15, it generally needs to be approved by the parties. Each party's rights need to be identified.
Right.
The payment terms identified. The contract needs commercial substance. And this is key.
Yeah.
It must be probable that the entity will collect the consideration it's due.
Probable collection. Got it.
Yeah. If those criteria aren't met, you might not actually have a contract under IFRS 15, and then the revenue recognition is different.
Okay. So assuming we have a valid contract, step 2 is identify the performance obligations in the contract. This feels crucial. It's about figuring out what the company is actually promising to deliver.
It really is crucial, and it's a really common area tested in the exam. As the study guide notes, again, under B10A, this is identifying performance obligations.
Okay.
So a performance obligation is a promise to transfer to the customer a distinct good or service.
Distinct. That's the key word.
That's the key word, distinct. You have to ask yourself, could the customer benefit from this good or service on its own, or maybe together with other readily available resources? If the answer is yes, it's likely a separate performance obligation.
Ah, okay. So if a company sells you, say, a new phone and promises free setup and throws in a 2-year maintenance plan, those might actually be 3 separate performance obligations.
Exactly, if they're distinct. The phone is distinct, right? The setup service is likely distinct. You could probably get it done somewhere else.
True.
And the maintenance is distinct. So IFRS 15 requires you to essentially unbundle these promises. This step forces companies to look beyond just the single contract document and see all the individual promises they've actually made.
That makes perfect sense.
Yeah.
So, okay, contract identified, promises unbundled. Step 3, determine the transaction price. What's the total amount the company expects to receive for fulfilling all those promises?
Right. B10A3 in the study guide covers this. It's the amount of consideration the entity expects to be entitled to in exchange for transferring those promised goods or services.
Okay.
Now, for many simple sales, this is just the agreed list price, easy enough. But it can get more complex.
How so?
Well, it might include variable considerations, things like discounts, rebates, performance bonuses, or maybe penalties where the final amount depends on future events.
Ah.
And you have to estimate that variable consideration, but you only include it to the extent that it's highly probable that a significant reversal in the amount of cumulative revenue recognized won't occur later on when the uncertainty clears up.
Okay, estimate the total pie, being careful with the variable bits. Then, step 4, allocate the transaction price to the performance obligations. So if we identified 3 distinct promises, phone, setup, maintenance, how do we split that total price from step 3 among them?
Okay, this is B10-4. If you have multiple performance obligations, you allocate the total transaction price to each distinct performance obligation based on its relative standalone selling price.
Standalone selling price, so what it would sell for on its own.
Exactly. What would the company sell that phone for on its own? What would they charge for just the setup service?
Sure.
What's the price for just the maintenance plan? You use those individual prices proportionally to split the total contract price.
And if you don't know the standalone prices?
Good question. If they aren't directly observable, you have to estimate them using reasonable methods.
Okay, that makes total sense. You're basically figuring out the value of each piece of the puzzle. And finally, the critical timing step, step 5. Recognize revenue when, or as the entity, satisfies a performance obligation. This is when you actually hit the sales button on the income statement, so to speak.
Precisely. B10AV covers this last step. Revenue is recognized when or as the entity satisfies a performance obligation by transferring a promised good or service to a customer. And that transfer happens when the customer obtains control of the good or service.
Control. Okay.
Control is the linchpin.
So that 5-step model is the journey you take for every single contract. Identify the contract, break down the promises, figure out the total price, split the price, and finally record the revenue as you deliver each promise.
Exactly. It provides a really structured way to think through revenue recognition. Now, you mentioned that final step when the entity satisfies the performance obligation and the customer obtains control. That's where the timing aspect really comes into play, and it's such a fundamental distinction. The visual overview separates this out, and the study guide B10B requires you to explain and apply the criteria for recognizing revenue either over time or at a point in time.
Okay, let's dig into that timing then. When do you recognize revenue over time? This feels like it would be for things that aren't just a simple one-off sale.
That's generally right. A performance obligation is satisfied over time if one of 3 specific criteria from IFRS 15 is met.
Okay, what are they?
Well, the most intuitive one is probably where the customer simultaneously receives and consumes the benefits provided by the entity's performance as the entity performs. Think of like a cleaning service contract.
Right, they benefit as you clean.
Exactly, hour by hour. Another criterion is if the entity's performance creates or enhances an asset that the customer controls as the asset is created or enhanced, like building an extension onto a customer's existing property.
Yeah.
They control the property, you're enhancing it. And the third one is a bit more technical. If the entity's performance does not create an asset with an alternative use to the entity, and the entity has an enforceable right to payment for performance completed to date.
Okay.
So many service contracts or long-term construction projects often fall into these over-time categories. The key thing is that the customer is benefiting or gaining control as the work progresses.
Okay, so it's a gradual recognition as the service is delivered or the asset is built under the customer's control. What about the sort of more traditional at a point in time recognition?
That's when the performance obligation is satisfied at a single specific point in time. This happens when control of the good or service transfers to the customer right at that moment.
Right.
The study guide under B10B requires you to explain and apply the criteria for this too. And IFRS 15 gives you indicators to help figure out when control is transferred.
Like what?
Things like the entity having a present right to payment for the asset, the customer having legal title, the entity having transferred physical possession.
Physical possession, okay.
The customer having the significant risks and rewards of ownership, and the customer having accepted the asset. Selling a car is a classic example, right?
Yeah.
Control usually transfers when the customer drives it off the lot. They've got legal title, physical possession, risks and rewards, and you have a right to payment. Point in time.
Control really is the central thing here, isn't it? Whether it transfers gradually or all at once. That makes a lot of sense. Now, if you are recognizing revenue over time, How do you measure how much revenue to recognize each period, say each month or quarter?
Excellent question. The visual overview specifically highlights measuring progress,
Yeah.
and B10C in the study guide requires you to describe acceptable methods for this.
Okay.
So when a performance obligation is satisfied over time, revenue is recognized based on the extent of progress towards complete satisfaction of that obligation. You need a method that accurately depicts the entity's performance in transferring control to the customer.
And what are those methods?
There are basically two main approaches: output methods and input methods. Output methods measure the value transferred to the customer. Think surveys of work performed, milestones reached, units delivered.
Okay, based on what the customer gets.
Right. Input methods, on the other hand, measure the entity's efforts or inputs used to satisfy the obligation, like costs incurred, labor hours worked, or machine hours used.
Based on the effort put in.
Exactly. And you need to pick the method that best reflects the actual transfer of control for that specific performance obligation.
Got it. All right, so we've covered recognizing the revenue itself and when to do it, but fulfilling contracts often involves costs, doesn't it? How does IFRS 15 deal with those? The visual overview points to recognition of contract costs.
Yeah, this is covered in the study guide under B10D. You need to understand the criteria for potentially capitalizing certain costs associated with contracts as an asset on the balance sheet, rather than just expensing them immediately when they're incurred.
Ah, okay. So treating them as an asset.
Potentially, yes. IFRS 15 distinguishes between two main types of costs you might capitalize.
And what are those types? The visual overview mentions incremental costs and costs to fulfill contracts.
Exactly those. Incremental costs of obtaining a contract are costs that an entity incurs that it would not have incurred if the contract hadn't been signed.
Like sales commission.
Perfect example.
Yeah.
Sales commissions paid specifically because this particular contract was signed. These are recognized as an asset only if the entity expects to recover those costs.
Okay, recoverability is key.
Absolutely. Then there are costs to fulfill a contract. These are different. They're costs incurred to actually satisfy a performance obligation that aren't covered by another standard, like, say, IAS 2 for inventory.
Okay.
These costs, think direct labor, direct materials, allocated overheads related specifically to fulfilling the contract, are recognized as an asset if they relate directly to a specific contract, and they generate or enhance resources that will be used to satisfy performance obligations in the future, and again, they're expected to be recovered.
Recoverability again. And the visual overview also mentions loss-making contracts briefly.
Yeah, it's something to be aware of. While onerous contracts themselves are dealt with under IAS 37, you absolutely need to consider if your expected revenue from a contract is less than the total expected costs of fulfilling it. That could impact the recoverability of any contract costs you've already capitalized as an asset.
Right, makes sense. This is where it gets really practical, doesn't it? Applying these principles to, well, trickier real-world scenarios, the visual overview calls these specific transactions, and the study guide lists them under B.10e.
Yep. And these are scenarios pretty much designed to test your ability to apply that five-step model accurately. The study guide specifically requires you to apply the IFRS 15 principles to these types of transactions.
So you can't just memorize rules for each one?
Definitely not. You have to work through the 5 steps, applying the principles to figure out the correct accounting treatment for that specific situation.
Okay. The first one listed, and one I know causes headaches for students, is principal versus agent. The study guide specifically flags this under B/10EI. What's the core difference here? Why does it matter so much?
Ah, yes. This is a classic distinction, definitely one to get your head around for the exam. The fundamental question you need to ask is the entity providing the good or service itself acting as a principal?
Okay.
Or is it just arranging for another party to provide the good or service, acting as an agent?
And the accounting is different.
Hugely different. A principal recognizes revenue on a gross basis, the total amount the customer pays for the good or service.
The full amount.
The full amount. But an agent recognizes revenue on a net basis, typically just the commission or fee they receive for facilitating the transaction between the other party and the customer.
Okay, so the difference isn't just about who sends the invoice, maybe. It's about something deeper.
Exactly. It's about who controls the good or service before it's transferred to the customer. That's the key insight.
Control again?
Control again. A principal controls the good or service before transfer and is primarily responsible for fulfilling the promise to the customer.
Yeah.
An agent does not control the good or service. They're just acting to arrange for the other party, the principal, to provide it.
Can you give an example?
Sure, think of Amazon.
Right.
When Amazon sells its own Kindle devices directly to you, Amazon is the principal. They control the Kindles.
Right.
But when you buy a product from a third-party seller using the Amazon Marketplace platform, Amazon is acting as the agent. They don't control that seller's goods. They just facilitate the sale and earn a commission.
Okay.
So you need to look at indicators like who is primarily responsible for fulfillment, who has inventory risk before the sale, who has discretion in setting the price for the good or service. Those help determine if an entity is acting as a principal or an agent.
That clarifies it really well. Thanks. Beyond principal versus agent, the visual overview and study guide lists some other specific transactions that require careful IFRS 15 application. Repurchase agreements, bill and hold arrangements, and consignment arrangements.
Yes, B10E2, 3, and 4 cover these. A repurchase agreement, or a repo, is where an entity sells an asset but promises, or has the option, to buy it back later. The question is, has control really transferred if the seller might just get it back?
Tricky.
A bill and hold arrangement is when a customer is billed for a product, but the seller keeps physical possession for a period, maybe at the customer's request. Again, has control transferred even if the customer doesn't have the item yet.
Right.
And a consignment arrangement is where one party, say a manufacturer, delivers goods to another party, like a retailer, but the manufacturer retains ownership and control until the retailer sells it to an end customer.
So the retailer doesn't recognize revenue until they sell it on.
Generally, yes. In all these cases, repo, bill and hold, consignment, you have to go back to those 5 steps, and crucially, the concept of control, to determine if and when revenue should be recognized. They're really designed to test your understanding of when control truly passes, which might not be the same time that legal title or physical possession changes hands initially.
So the 5-step model and that core concept of control are basically your diagnostic tools for navigating all these different scenarios. Okay, now let's connect this all back to the balance sheet, the statement of financial position. The visual overview has that box linking revenue recognition to the SOFP, highlighting performance by parties and balances.
Yes, and this is a really crucial flow-through effect. Applying IFRS 15 often results in new asset or liability balances popping up on the statement of financial position related to these customer contracts.
Why is that?
It happens because the timing of satisfying performance obligations, when you actually earn the revenue, doesn't always perfectly match the timing of when the customer pays the cash. There can be a lag or an advance.
And those resulting balances are the contract assets and contract liabilities, right?
Exactly those. A contract asset arises when the entity has satisfied a performance obligation, so they've earned some revenue, before the customer pays, and before the entity has an unconditional right to that payment. It represents the entity's right to consideration for performance completed so far. But maybe that right is still conditional on something else happening, like completing another part of the job.
So it's like earned but not unconditionally billable yet?
Kind of, yeah. You think of it sometimes like work in progress that's been recognized as revenue but isn't quite a straightforward trade receivable yet.
Yeah.
A contract liability, on the other hand, arises when the customer pays consideration before the entity satisfies the related performance obligation.
Like a deposit or payment in advance.
Exactly. It represents the entity's obligation to transfer goods or services in the future for which it has already received payment. It's basically deferred revenue or unearned income. So these balances, contract assets and contract liabilities on the SOFP, give visibility into the status of ongoing customer contracts, who owes what performance or payment.
Okay, that really nicely connects the income statement timing to the balance sheet position. This has been a really comprehensive look at the principles. Now, thinking specifically about the ACCA financial reporting exam, how should students expect this whole topic to be assessed?
Well, the study guide is very clear here, especially in Section 3 and looking at the B10 learning outcomes themselves. This topic, revenue recognition, is assessed at intellectual level 2.
Level 2 application and analysis.
Exactly. Application and analysis, that's the key thing. You won't just be asked to list the 5 steps or define performance obligation. You will be given scenarios, often involving those specific transactions we talked about, like principal versus agent or bill and hold.
Right.
And you'll be required to apply the 5-step model to determine the correct revenue recognition, figure out the timing, calculate the amounts, and potentially show the impact on the financial statements. You need to be able to analyze a contract, break it down using the IFRS 15 framework, and figure out the accounting treatment.
So practice applying the framework is essential, especially working through questions involving those specific examples. And Section 7 of the study guide also reminds us that FR questions can come in different formats, right? Objective test questions in Sections A and B,
Yes, multiple choice, multiple response, fill-in-the-blank types questions.
or those longer constructed response questions in Section C.
That's right. You might get an objective test question focusing on a specific aspect, like identifying performance obligations in a short scenario, or maybe calculating variable consideration. But you could also face a much longer constructed response question in Section C that requires you to apply the full IFRS 15 model to a more complex contract scenario. Show your calculations, maybe prepare journal entries, and explain the impact on both the statement of profit or loss and the statement of financial position.
And it can be integrated with other topics too.
Absolutely. As that syllabus diagram on page 4 shows, Area B, which includes revenue, is a fundamental building block for Area D, preparing financial statements, and Area C, analyzing financial statements. So you can easily see IFRS 15 principles being tested within a larger question about preparing or analyzing extracts from financial statements.
Good point. So this deep dive has walked us through the really critical landscape of revenue recognition for your FR revision. We've covered that foundational IFRS 15 five-step model. We've understood the crucial timing distinction, recognizing revenue over time versus at a point in time.
Yep, and how to measure progress.
We discussed how to account for the related costs of obtaining or fulfilling contracts, explored how to apply these principles to specific common transactions, like that really tricky principal versus agent scenario.
Definitely a key one.
And we've seen how all of this ties back to balances like contract assets and contract liabilities showing up on the statement of financial position.
And mastering these principles, but maybe more importantly, practicing their application through question practice, is absolutely your key to confidently tackling revenue questions when you sit the exam. It's really about developing that systematic approach that the five-step model gives you.
Absolutely. So as you consolidate your understanding of Chapter 5, maybe take a moment to consider this provocative thought. With the business world constantly evolving, we're seeing ever more complex service bundles, subscription models, digital deliveries, AI-driven services. How will accountants and the standard setters themselves continue to refine and apply standards like IFRS 15 to accurately capture the true economic substance of these really innovative, sometimes quite intangible revenue streams?
That's a really interesting point. It's a framework built for today's transactions, but it will certainly be tested and likely need interpretation or even evolution for the business models of tomorrow.
Definitely something to think about beyond the exam.